Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers, where I challenge wealth professionals to replace a 10th of an hour of their day with a 10th of an hour of learning. For today's episode, episode 10, we're going to cover a recent IRS private letter ruling which illustrates whether there is relief for late IRA rollovers, especially outside of the CARES Act relief provisions which have recently been clarified. Now, this isn't designed to be a discussion on all types of rollovers that are possible out there, but I cite this general rule here where if you take a distribution from an IRA, you typically have 60 days to put it back into the same or a new IRA or other qualified retirement account as a rollover contribution. And if you fail to do so within the 60-day period, then the distribution will become taxable, and in addition to the income tax on the distribution, you could incur a penalty tax if it's an early IRA distribution. Now, that's a very tight window of time, so the big question is there any relief if you goof up and miss this 60-day deadline? And the good news is that there might be. In a recent IRS private letter ruling, we saw one example of many situations where this has come up and the IRS has granted relief, but this letter ruling creates a good illustration of some of the facts and circumstances that the IRS can take into account in waiving this 60-day rollover deadline. So in this case, we had a taxpayer who was a divorcee, and the financial institution gave her a distribution from an IRA, but she didn't know that it was a distribution from an IRA, so she passed the 60-day rollover deadline. But the good news is that none of it was spent. Instead, she placed the distribution into a taxable account and didn't draw on it at all. Now, it's important that there had been an intervening divorce. The taxpayer had been dependent on her former spouse for financial advice, and she alleged that the financial institution did not inform her about this 60-day rollover deadline. But then, the next year, she was surprised to get a 1099-R for this distribution, alleging that she had income tax liability for it. So, she wrote to the IRS and asked for relief, and the IRS did indeed grant that relief and waived the 60-day rollover requirement with respect to this divorced taxpayer. Now, it's important to note that this isn't a one-time thing. The IRS is given the general authority to waive the 60-day rollover requirement in situations where asserting the deadline would be against equity or good conscience. So, the procedures for getting this type of relief are set forth in Revenue Procedure 2003-16, under which the 60-day requirement can be waived if the relevant facts and circumstances warrant. Now, those would include an error by the financial institution, the inability to complete the rollover due to intervening factors, the use of the amount distributed, and the time elapsed since the distribution occurred. Now, all of these were met in the eyes of the IRS in this recent private letter ruling. There could have been an error by the financial institution, just an error to inform, but that's not a hard and fast rule. But I think the IRS gave the most weight to the fact that the taxpayer in this case was dependent on their former spouse, no longer had their former spouse's financial advice, and because of that, they didn't know how to treat this distribution and what the source of the distribution was. Now, one thing that helped here too was the use of the amount distributed. The fact that it was locked away in an account and wasn't touched helped the taxpayer in this case to get this relief, and the time elapsed since the distribution occurred. I think in this case it's important to note that as soon as the 1099-R was received, the taxpayer took action to seek relief from the IRS. Now, if years had elapsed, that creates less of a compelling reason to actually grant relief in this type of a situation. Now, it's important to note that this week as well, or actually last week, I believe, the IRS issued Notice 2020-51, which affects rollovers under the CARES Act. And really what this clarifies is that the CARES Act relieved the RMD requirements for 2020, and in that light, relieved some of the rollover requirements for 2020. So, if you took an RMD more than 60 days ago, you can now put it back into an IRA or qualified plan by August 31 of 2020 under this IRS notice. So if you pass this deadline, could you then, as a backup, rely on Proc 2003-16, as we just discussed, which gives late relief to a missed rollover deadline? The situation is, yeah, you may be able to based on the facts and circumstances, especially because COVID has created a situation where it's an intervening factor that could prevent a timely rollover, but you may not want to rely on this because what's unwritten in all this is the fact that when you create a request for a letter ruling, you have to submit an IRS user fee, and you have to go through the expense of having an attorney prepare the request for the written determination as well. So even though relief is available, it's important not to procrastinate and rely on that backup relief, because you could just as easily pay a lot of money and get dinged and not get the relief you are so seeking. Thanks again, everybody, for joining me for this episode of the 10th of an Hour. As always, if you have questions or topic suggestions, please email them to me at griffin.bridgers@gmail.com. Thanks again for joining, and I look forward to seeing you in the next episode.